I was pretty much alone last year when I predicted there would be no property price crash in 2021. But after the budget, I now firmly believe that the UK government wants property prices to rise. And in this video, I'm going to share with you exactly why property prices will rise and how you can act now to benefit. Hi, my name is Ranjan Bhattacharya. I've been investing in property for 30 years. You may have seen me on the hit Sky TV show Property Elevator, or you may have attended one of our popular property networking events in central London. If you're new to this channel, well, where have you been? Don't go away without subscribing and clicking the bell icon because we put out new content each and every week. It's all dedicated to keeping you on top of your property investing game. Now, last year was a little lonely for me. While everyone else was out there predicting a massive UK property price crash in 2021, I laid out my reasons why this was simply not going to happen. This is the video I put out in November 2020. Generally, you guys were very supportive of my argument and what I was saying. Had about 1,400 likes to 132 dislikes and over 44,000 views, so there was something that resonated with a lot of you. But that's not to say some of you didn't really hurt my feelings in the comments. So we had comments like this, of course, this guy doesn't have a clue what he's banging on about, and anyone basing financial decisions on this plonker's advice honestly deserves to lose their money. And then we got this crystal ball gazer further down. Everything in the housing market comes to an end in March with a big crash. Well, we're in March right now, and it hasn't exactly worked out like that, has it? But I'll leave you guys to recap and watch that video later and scroll through the comments if you want to have some fun. But in that video I was saying, and I was the only one saying this back then, was that in 2021 there ain't going to be a property price crash here in the UK. The writing was on the wall for property prices as soon as the government decided to print so much money at the beginning of this COVID crisis. It's now up to nearly £750 billion that has been printed, which takes the total national debt up to nearly £2 trillion. Now, when you print so much extra money, the value of that currency goes down, and you need a lot more of it to buy the same things that you would have bought before. And what happens is that anything that's finite, such as property, tends to go up in price. So when property prices are going up, we're not really saying that the value of those houses have gone up. It's just that the price has gone up because there's so much extra money that has been pumped into the economy. And that's what we call inflation. Now, this same thing happened after 2009, when the government printed £300 billion to deal with the financial crisis. And it will happen again, because they've already printed 3 times more money than they printed back then. So last year, my concerns over the sheer amount of money printing which went on was behind the reasons why I was predicting with confidence that house prices would not crash in 2021. So I predicted back then that there'd be no change. But this year, there's been still more money printing going on, and there's still more to come. So now that we've just had the March 2021 budget, and having had a chance to digest all of it and figure out what it all means, I am absolutely convinced that there's an unwritten government policy to actually encourage property prices to rise. And here is why. Some of the measures in the budget are a little bit sneaky. Now, at the end of the day, all these billions of pounds that the government have basically borrowed by printing more currency has to be paid back. One way to pay back all this borrowed money is to actually encourage a little bit of inflation. With a little bit of inflation, you increase the price of everything, but the price of the government debt stays the same, but everything else is going up in price. When the price of everything goes up, obviously the tax revenues go up as well. And this can be used to pay down some of that debt. So that seems to be the government plan, to let inflation rip a little bit, get it to about 2 to 3%, keep it steady at about that sort of level, and then benefit from the increased tax revenues to help chip into some of this debt mountain. The trouble is that inflation is not an easily controllable beast. Once it's unleashed, it could easily get out of hand and be difficult to control.
Right all the time.
And if that happens, it's basically bad news for everybody. And this time round, there is a real risk of the inflation beast getting out of control. And here's the thing, in 2009, when they printed an extra 300 billion to deal with the financial crisis, they printed that money and gave it to banks. This time round, the bulk of that money has been printed and given to individuals and small businesses directly into their bank accounts. With lockdown, of course, people haven't had the opportunity to spend a lot of that extra money. But once we're out of lockdown, we're going to see a lot more cash spending, which will put inflationary pressure on the entire economy. And the last thing we want is a return to the UK in the 1970s, when inflation was in double digits and caused huge problems. Or worse still, end up like Zimbabwe or Venezuela. I mean, here's a classic $100 trillion Zimbabwe note, where basically money printing got so out of hand, the currency became worthless. So if you think I'm talking some sense, or even nonsense, then let me know in the comments below. Smash that like button as well, because it means YouTube will show this video to more people like you. Now, inflation is not all bad, as long as it's matched by an increase in economic activity. The problem we have is that we may end up with the dreaded stagflation. That's a phenomenon where you see rising inflation in prices, but there's no corresponding increase in economic activity in the country. And this is exactly what happened in the 1970s. And that's where the you-know-what really hits the fan. Now, this is where the budget measures come into play. Now, there are several measures in there which will encourage a little bit of inflation, and this will of course help pay the debt. But there's some very, very interesting measures in there which have been thrown in, I believe, to prevent the spectre of stagflation. Now, let me set out for you exactly what's going on. Now, property prices are very important to the psyche of the UK, and they're very important to the feel-good factor and the mood of everyone that participates in the UK economy. When people buy or sell property, a lot of economic activity is generated, which leads to more tax revenue. Now, we have a lot of property taxes in the UK. The OECD did some research recently that put the UK at the top of all the G7 countries in terms of the amount of tax revenues which are generated from property. In the UK, 12.5% of total tax revenues actually comes from property, compared with 12.1% in the USA, 11.6% in Canada. So we're top of the bunch. So the point is, they need the revenue from property taxes, which is going to go a significant way into helping chipping away at this debt. So there is an inbuilt incentive to ensure that property prices not only do not fall, but actually go up. So with that in mind, there's going to be nothing in the budget that's going to see property prices go south, especially as we need to encourage activity and recovery after COVID-19 lockdown is lifted. And that's why we saw a whole host of measures in the budget, such as the SDLT holiday for transactions up to 500k being extended till June the 30th, and then a further 3 months where the limit will be reduced to 250k until 30th of September. So this measure alone will ensure that transactional activity in the housing market is encouraged in the crucial summer season as we come out of lockdown. The sneaky freezing of tax allowances means that as people earn more, they will be dragged into tax bands they wouldn't otherwise be in. So it's a bit of a stealth tax, that one, but it will hit everybody. But this was the announcement in the budget, for me, which joined up all the dots. The government is introducing what they call a super deduction on capital expenditure for businesses.
For the next 2 years, when companies invest, they can reduce their tax bill, not just by a proportion of the cost of that investment as they do now, or even by 100% of their cost, the so-called full expensing that some have called for. With the super deduction, they can now reduce their tax bill by 130% of the cost. Let me give the House an example. Under the existing rules, a construction firm buying £10 million of new equipment could reduce their taxable income in the year they invest by just £2.6 million. With the super deduction, they can now reduce it by £13 million. We've never tried this before in our country.
So how will this work? Well, if a business spends £100,000 on qualifying capital expenditure, they can claim £130,000 from their taxable profit. Now, with corporation tax currently at 19%, this equates to a tax saving for businesses of £24,700 on that £100,000 of capital expenditure. It's estimated that UK companies are sitting on £750 billion of cash. Now, in theory, incentivising them to spend it means that they will probably spend it on stuff that increases their productivity. Now, this seems to me how the government is planning to square the circle, i.e. have a little bit of inflation to help pay down the debt, but do something to make sure we don't get into stagflation by encouraging businesses to spend their cash. This super deduction runs from the 1st of April 2021 all the way up to 31st of March 2023. With this super deduction set at 130%, it'll make certain capital expenditure more viable than it did before. And it's available for all businesses, and basically any expenditure which would normally be eligible for capital allowances would apply for this super deduction. What perked my interest was that this has never been tried in the UK before. 100% capital deductions have been allowed before, but never 130%. To me, the unwritten agenda is clear. The super deduction and all these measures on the housing side, such as the extension of SDLT and the new first-time buyer 95% mortgages, it is clear that the government is dancing with the devil in trying to encourage a little bit of inflation to help clear some of this debt. So for property investors and developers, prices will rise. And they will rise to reflect the fact that there's so much extra money that's been pumped into the economy. Developers need to be wary of costs in materials rising through the course of a project, and they need to plan for that eventuality when they take on board a project and do the initial costings. For buy-to-let portfolio investors, it's relatively good news because the price of your property portfolio will go up, but your debt level will be frozen. But if you own property in your own name, then when you sell, expect to pay more capital gains tax at some point. Now, in this budget, there were no changes. In fact, the Rishi Sunak didn't even mention capital gains tax. But I think the direction of travel is set there, and we are going to see changes or increases to capital gains tax later on, which makes sense. Inflate the prices a little bit and claw it back through extra CGT. So now's the time to plan ahead if you own properties in your own name. Got plenty of videos to get you started if you want to have a look at those. If you're liking this video, let me know by smashing that like button. And if you're not already a subscriber, subscribe and hit the bell icon because it's a rapidly changing market and we're going to be keeping you up to date with weekly videos to keep you informed. If you have cash in the bank, you're going to see it erode in value. And the best place for it, if you want to preserve the value of that cash, is to put it in something that's finite. In other words, something that the government can't print. And property has always been a great place for this. Now's not a time to do rent to rent. The opportunity now is to own assets, not control. We'll see prices grow in the next few years, and if you do rent to rent, you'll be left having done a whole lot of work with no opportunity to own and benefit from those rising asset prices. I've done a whole video on the pitfalls of rent to rent. You may want to watch that if you're considering that strategy. A better way to do rent to rent, of course, is to do lease option. Basically, you lease the property from your landlord and you pay them a monthly rent, but you have the option to buy it at a predetermined price at some future point in time. Thereby, you kind of benefit from the best of both worlds, but that's all for another video. Commercial property in particular is in massive oversupply, particularly retail units and offices. And now, of course, we have ever more permitted development rights to allow these properties to be easily repurposed without having to go through convoluted planning permission. If you pick up a commercial property and repurpose it to residential use, you can increase its value by 3 or 4 times. If this strategy appeals to you, then join me for some free training I've got lined up on this subject. 90 minutes of free training. I'll take you through this whole subject in some depth. The link is in the description below. So to wrap up, the direction of travel for property prices is now set. If you're expecting to pick up a bargain as a result of some massive property price crash in 2021, then I'm sorry to disappoint you. It simply ain't going to happen. Instead, we're going to see property prices rise. And over the next couple of years, I wouldn't be surprised to see growth in property prices in the UK of at least 10%. So none of us have a crystal ball. I mean, I don't really have a Scooby-Doo. I'm just some random guy off YouTube. I was right last year, but who knows whether I'm right this year. Tell me what you guys think. Tell me in the comments below. So go out there, invest in property and prosper. Bye for now. See you guys in the next video.